Good afternoon, everybody. It's 12 o'clock, and that means it's time for another episode of Stock Picks brought to you by the JSE. We have a fantastic panel this afternoon to give us a sense of where can we find value in the stock market in this interesting time that we're in, with everybody waiting and bated breaths for interest rate cuts, waiting to hear how the election goes. But the market keeps moving, and our experts have excellent stock picks for us today. So it's my pleasure. I am Sam Mokorosi from the Johannesburg Stock Exchange, and I head up origination and deals at the JSE. Our panel includes Gary Boyson, who is portfolio manager at Ranswiss. Welcome, Gary. Gary's been with us before. We also have Natasha Senge from Mazi Asset Management. She is the head of research, and she's an analyst there. We've got Tbea SOA, who's portfolio manager at Mianzo Asset Management. And we've got Nerina Fisser, apologies, from ETF SA. Very nice to have you, Nerina. We're going to start with Gary. Gary, you've been with us a few times, but maybe you want to start off with something that the audience might find interesting and as an icebreaker, as it were, about yourself.
I think I've been on a few times, so everyone knows everything about me. So I don't know if I've got an icebreaker. So I think you suggested that you were saying if we were going to run comrades. So this, I'll tell you, I actually do run, which people might find surprising if they know. Like I weigh 111 kilograms at the moment. I'm 6'5", so running is like really a terrible sport for my joints and my legs. It's just I'm not a runner. But I ran my first Two Oceans half marathon this year. It was incredibly fun. So I'm trying, even though I think my genetics are against me.
Well done. So 21 Ks. What was your time? Tell the whole world.
I think it was 2.5 hours.
Okay,
yeah, 2.5 hours. I mean, how do you know someone's training for a marathon? They'll tell you. So I think it was about 2.5 hours. Like I said, I'm really not fast. I'm genetically not built for running, but I try anyway.
Good. Well, let's hear your stock picks and take it away.
Okay, first stock pick. Let's go with British American Tobacco. So it's obviously a giant company. I mean, we're talking, normally we have to pick small caps on this show, but today I think they broadened the horizon a little bit. So I decided to go for one of the biggest stocks on the exchange. Market cap is 1.3 trillion. It's a really solid dividend player. So I mean, you're looking at about a 9.5% dividend yield, and it is a mature business as well. So I mean, this is obviously, it's tobacco and nicotine products. And one of the questions I kind of asked myself is, should you be buying a company that could potentially have declining revenue? And for me, I just kind of look at it at the scale and how well the business is managed. I mean, if you look at it, they make around just over 27 billion pounds. So it's about 670 billion rand per year. That's the 2023 numbers. And if you look at that, you're only paying around 2 times sales for this. If you look at their forward earnings, so their earnings have been a little bit spotty. They've gone through a big kind of cost-cutting initiative as well. But if you look at it, you're paying on a 1-year forward, you're paying around 6.7 times. So it is really not expensive. And I think that's also given where it is in the cycle at the moment. Obviously, the opportunities for the business, I mean, for us, wonderful. You can buy it in a personal share portfolio. Potentially, that's in let's say, your retirement annuity. Retirement annuities obviously are constrained by Reg 28. But this is essentially a local stock that gives you a wonderful rand hedge company. The technical picture on it looks really, really good. And I think the reason that I'd be buying it now is that with that high dividend yield, it's often seen as almost a competing product for a bond. Because you've got this high dividend yield. It's a very mature company. Their sales are very, very stable. And if we go into a falling interest rate environment, I think this would make a compelling offering. It becomes more attractive to investors that start to hunt for yield, and then you might see just an uplift on the share price as well. And of course, there's all these next generation products. So I also did a quick survey in the office because I was like, who actually smokes these vapes? And I mean, now apparently among the younger staff in the office, they were telling me, no, it's all about these pouches. So it's Zins, and the version that British American Tobacco has is called Velo. And they're actually all nicotine pouches that you put in your mouth. And I said, but do people really use this? They say out of their friends, 95% of people are using them. So even though you would imagine with increasing health trends and just awareness around the dangers of nicotine, that people wouldn't be using these products, but let me tell you, they are still absolutely rampant. And that makes an addictive product makes for good shareholder returns usually. I think one of the risks is obviously going to be the regulatory requirements, regulatory impact that can be had. But overall, Vu's basically the biggest vaping brand in the market. As I said, already mentioned the Velo pouches. So I think at this stage, probably a good entry point into a nice rand hedge stock. Do I go straight on to my next topic?
Yeah, go for it.
Okay. So the next, we're just going to roll all of these at once. Okay.
Yes.
Next stock pick is I'll go with BHP. So ticker is BHG on the local exchange. Basically the world's biggest commodity miner. I really haven't shied away from picking big stocks today. It's been making news because it was looking at taking over Anglo American. Currently, it's not going to proceed with the deal, which actually gave us about a 3% uplift on our fair value on the stock because I think they were going to pay a little bit too much for it. It's now under the put up or shut up rules. They can't make an offer for Anglo American for another 6 months under the takeover merger regulation code in the UK. But really largest miner by market cap. It's focused, I think, on the correct metals and minerals. It's been buying different copper producers recently. So Oz Minerals in 2023, increasing its copper exposure. It's also quite close to the biggest commodity consumer in the world, which is China. If you compare, to something like Vale or Rio Tinto, even to our own Kumba, the transport cost of getting that iron ore to market is significant. They do have an advantage there because a lot of their mines are in Australia, much closer to their end consumer. That is also a little bit of a risk for the company. I mean, about 60% of their 2023 sales actually went to China. So it's a very, very important market for it. And I think you can always make an argument that China is moving away from that kind of infrastructure-led economy. At the same time, it's currently got a trailing 12-month dividend yield of around 7%, and we expect that to maintain about a 5% dividend yield, which is pretty decent. It's trading on a one-year forward of only about 10 times, so it's also not expensive. And I think the big growth is potentially going to come from the mine that they're building in Saskatchewan in Canada, which is it's called the Jansen Potash Mine. So it's potash. If you don't know about potash, fascinating commodity. It's absolutely key in fertilizer and therefore food security. And if you look out to 2025, they're expecting a world population to start approaching around 10 billion. This is actually absolutely critical component in the production of food at that scale. And obviously we have the conflicts between Ukraine and Russia continuing, and we've seen actually potash coming out of the market. Potash production has been reduced, because of its, specifically in Belarus and kind of those old Eastern Bloc countries. So this mine, I think, it is an exciting prospect for British, at least for BHP going forward. Final stock pick in 1 minute and 20 seconds is going to be FirstRand. It's the largest of the South African banks by market cap. I think the idea behind a stock pick in FirstRand is one, it's short of Capitec, which is a little bit of a different business to FirstRand, to the more traditional banks. It has the highest ROE of all of our banks. Its ROE is almost at 19. The next best, excluding Capitec, is Standard Bank, which comes in about 17.68. So very, very high ROE. Our banks are not expensive compared to their international peers. Why are our banks not expensive? Obviously, there's a big concern around the growth prospects in South Africa. Obviously with load shedding, at the moment a very uncertain political situation as we wait to see what form our government will take, and I think that's adding a significant risk premium. Now, if you're going to, if you're not buying a giant commodity miner, overseas, or something like British American Tobacco, another rand hedge multinational, and you are buying something that you want to capture optimism returning to South Africa, I think FirstRand is the way to go. Like I said, really, really cheap, really, really big, innovative, digital bank, and you'll know them from their brands, RMB, Westbank, F&B, etc. So, yeah, buy FirstRand.
Great, thanks, Gary. I think the theme of a cheap kind of environment in the South African stock market is definitely something that we've been hearing a lot. And that's not the first bank. That's not the last bank we'll be hearing about. I think there's another some more banking products coming along in sort of the ETF portfolios later. But let me hand over to Natasha. Welcome, Natasha. Really great to have you. You want to tell us something about yourself before you jump into your 3 shares?
Yes, Sam, and thank you once again. So something about me, used to be a Sudoku addict. So I had about 3-4 apps on my phone. And then prior to that, I was collecting a lot of magazines. So yeah, I kind of stopped that habit. Nice habit to have, but takes a lot of your time. Yeah, so yeah, that's an interesting fun fact about me.
Helps with the mathematics, eh? The arithmetic,
Definitely.
yes. Go for it, Natasha.
Okay, so I'll start with my first pick. It is a bit of a popular one on the show, so Reunert. This is a company that has a portfolio of businesses participating in electrical engineering, applied electronics, ICT. They supply products and services in various sectors, so power and electricity, defense, a bit of renewable energy, the IT space, just to name a few. And it has both a continental and an international presence. In terms of the investment thesis, I think that, Reunert is well positioned to kind of capture some of the trends that are playing out in the markets that they serve. So, for example, the company's cable business, I think given the impending electricity grid infrastructure updates that are coming, it's well positioned to kind of capture that. And moreover, and more interesting is the opportunity within the wheeling space, which will be needed, as we kind of add more sort of renewable into the energy generation mix. Within renewable energy, that value chain, it remains attractive for Reunert. They participate in an end-to-end a solution. So whether it be through EPC, which is engineering, procurement, construction, or BOO, which is build, own, operate kind of models, they are well positioned to capture those projects as they come on stream. And they're also suppliers of, these large energy storage batteries. In terms of load shedding, I mean, question has been asked, load shedding seems to be coming to an end. What does that mean for renewables energy? I think, not much of an impact, just given that, the savings that you might get when offsetting some of the tariff increases that Eskom will probably pass through. In terms of applied electronics, Reunert supplies radio and radar equipment and, mostly to the defense sector. And the business continues to get international support in terms of that in markets such as China, India, the Middle East. And I mean, we've seen it, as geopolitical tensions persist, defense spend, will continue to support that business. And then lastly, the ITC business, it's a play in digital integration or digital transformation. The company is currently betting, recent acquisitions there and, to offer and provide quite an end-to-end sort of service-led offering. And this will result, we believe, in an annuity kind of income for the business. When you look at a business financially, I mean, Reunert, very lowly geared, quite cash generative, and has kind of delivered a reliable growing dividend. My next pick is Bidcorp. This is a global food services distributor. It has presence in both developed and emerging markets. Bidcorp has a leading position in such a fragmented food services market. And so there is opportunity to kind of consolidate that market. And they do it quite well through bolt-on acquisitions that are accretive almost immediately. The food services market itself continues to show attractive growth prospects, given the trends around away from home eating as well as food delivery. I personally like Bidcorp's sort of decentralized operating model. I think that allows its various business units agility, as well as a more focused approach on driving performance. So, these business units almost act in an entrepreneurial kind of spirit. On the profit side, the company has margin expansion opportunity by moving towards sort of higher margin customers and increasing their value add and private label products. In terms of outlook, although growth rates are normalizing due to food inflation kind of slowing down from the previous highs we've seen, I think the company can still sort of deliver positive volumes, going forward. And then financially, Bidcorp flexible balance sheet, quite, with cash generation that allows them to continue to invest in growth and also in these high margin revenue streams, and then also deploying some money sort of back to shareholders. And then last but not least, I've chosen the new kid on the block, We Buy Cars. So this is a leader in the used cars trading market in South Africa. I think the growth in the used cars market is well supported by the car park, meaning, cars registered on the road. And it's also supported by, the fact that cars are longer lasting and in that manner, you tend to get multiple sort of owners within the life of the vehicle. And used cars as well, it's an affordable option relative to most new cars in the market. One thing about We Buy Cars, it's developed quite a strong brand identity, and it has broadened its geographical footprint. And this has positioned the business to, capture growth at scale in a fairly sort of fragmented pre-owned car market. It's capital light, and it has quite attractive stock turnover rates. The business also offers access to finance, insurance, and warranty. This is predominantly through third parties, but they do get an additional income stream from them. And that part, the F&I side of things is gaining quite a lot of traction. Another point about We Buy Cars is the fact that, they are OEM brand or OEM brand agnostic. So this provides diversification for them. They're able to supply to an array of customers, so they're not bounded by one OEM or one brand. And a differentiator of the business is the use of their long-standing proprietary data, and applying that into AI and data analytics helps them enhance sort of their pricing strategies and track their market trends accordingly. I think the company can continue to grow. Car ownership in South Africa remains an aspirational. And, given the less sort of reliable public transport system, and the fact that in the used car space, you can get an affordable price car, there is still some scope for growth. Although the stock has had a great debut, if you look at the international counterparts, they trade at sort of double-digit PE multiples, and at 10 times multiple, given that they can still grow, their earnings grow double-digit, I think there is still some scope for a bit of re-rating there. Thank you, Sam, and I'll leave it at that.
Thanks so much, Natasha. I remember We Buy Cars listing event about a month and a half ago with fondness. There was much jubilation and excitement with that particular listing event. I think on the electricity side, while we're having a good reprieve from load shedding, even the National Energy Plan expects that we need to be improving generation capacity for a long time. So I think there's some macroeconomic and structural support there in the electricity market. Tbea, really great to have you.
Thank you, Sam.
Tbea is portfolio manager from Mianzo Asset Management. Something about yourself, please, ma'am.
I think when Sam, you told me that I have to figure out something interesting, I realized how I'm just not an interesting person.
That is not true,
But,
I'm sure.
Yeah, I've got a very sports-centered household, all full of boys, and I've been forced to get into sports, and I've finally got the sports that I like. I am a big F1 fan.
Oh wow. Wow, that's fantastic. Who's your favorite at the
I
moment?
have my long-term favorites. We're coming up to the Canada Grand Prix this weekend. I am rooting for Carlos Sainz because I think he deserves a seat next year. But he's not my long-term favorite, but I find myself this year really rooting for him. I think we've got, we still need to see him on that F1 driver lineup.
Fantastic. Let's go for your stock picks.
Okay, so I've decided to kind of stick to a theme, and the theme is that, as we all have seen, most of South African stocks have been trading under a very tough macro, especially those that have been exposed to consumer spending. The consumer remains constrained. So the companies I'm looking at is those companies that have some kind of quality element in it, a competitive advantage, which I believe will help them trade through this environment. And these are the companies that should perform well in a recovery. So first up, we've got Famous Brands. Famous Brands is the quick service restaurant and casual dining franchise business. They've got two big portfolio brands under the business. That's Leading Brands as well as Signature Brands. In Leading Brands, it's your likes of quick service restaurants, Debonairs and Steers. And then in casual dining, you've got Mug and Bean and Wimpy. In Signature Brands, it's more the bespoke dining restaurants, and that is the likes of your Paul's and Turn and Tender. They also do manufacturing, logistics, and distribution to support the supply chain for their stores and also franchisees. And then you also have a retail standalone business. That's where you see their products in the supermarket shelves, like in Pick and Pay and in Macro. Now, 92% of the business's revenue is generated in South Africa. They've got some stores in Africa and Middle East, as well as Wimpy in the UK. So a bulk of the business is actually in SA. Now, why I like Famous Brands, I'd actually buy it just for the Leading Brands. Leading Brands is the second largest market share in the consumer food services sector after KFC. It's very appealing because of the good brands that they have. Some of the brands under Leading Brands are also leaders in their categories, like Debonairs in the pizza category. And then also they've got good location as well as experienced franchise partners. I mean, of recent, in the recent years, we've seen them struggle with things like load shedding, fuel prices, and also things like water stoppages that have interrupted their trading. But it's been also challenging for management to try and manage these input cost pressures, as well as push through selling price increases without seeing significant volume decline. But they've managed to do that. In the 2024 financials, you saw that in the casual dining segment, in the Wimpies and the Mug and Beans, they were able to push through selling price increases without losing any volumes. On the quick service restaurant segment, they were able to also still push through selling price increases, but they lost a little bit of volume. And that's where you start to see that benefit of having experienced leadership as well as experienced franchise partners. I mean, 45% of their franchise partners have more than 10 years in franchises. And then it's also a high margin business. You're talking an operating margin of 50%, and that's been peaked at 60% in the past. If you look at Signature Brands, it's been loss making, and now it's currently positive, but you're looking at operating margins between 5 and 6%. So nowhere near the 50% that you're seeing in the Leading Brands. So really, I would buy it on for the Leading Brands because it's got good fundamentals. And the balance sheet, they've since cleaned it up. I mean, the debt levels are at a level that's more palatable. So at current PEs under 50 Rand, it's an attractive entry point. Next, we've got Astral. Astral is an integrated poultry producer. When you buy Astral, you've got two businesses, a feed business and a poultry business. The feed business is a quality business, stable margins. They're able to push through inflation to customers without losing volumes. They're strategically located so that they can manage their costs very well. So really a well-run business that is not much of a concern. The poultry business is subject to cyclicality, but it's got good operations. Now, there's a good case for poultry production in South Africa because poultry remains the cheapest source of protein that we produce in meats locally. So it does end up making it into the average consumer basket. So of late, last year, they've had some significant headwinds like load shedding that created the big bird phenomenon. And then also you had the avian flu. But in the recent financials, they've managed to trade out of that. And I believe it's because of the quality in their operations. They focus on the efficiency of farming as well as in the efficiency in their processing. They're currently processing 4.9 million birds a week. They've got capacity to process 6.2. They can increase that capacity without actually increasing costs. And they remain a low-cost producer. So really a very appealing company at this point. And then they've got very little debt. Management is, I believe, they're going to pay down the remaining debt that they incurred, and then we should see the dividend resume. And then lastly, we've got TFG. TFG's got the Africa business as well as their London and Australia business. Post-COVID, they benefited from the diversification of having the London and Australia business. We saw that contribute positively whilst Africa was in a decline. They've been heavily investing in Africa, and in the third quarter trading statement, we saw that the volume, the sales are starting to decline in London and in Australia. So the focus is on the Africa business now. All of this heavy investment that they've done, it's time for them to actually make it yield the returns. And I believe that they've invested in the top line growth by acquisitions like Tapestry and Jet, and as well as the invested in their systems and the costs. They've invested in quick response manufacturing as well as in the bash.com. So their margins remain very depressed. Their GP margin is sitting at 39.5%, lowest it's ever been. And there is a case of margin improvement. Now, Africa is a big chunk of the business. So the valuation of TFG is very sensitive to Africa margins improving. And I believe that there is a case for a margin improvement going forward in TFG. Some of the one-offs we're not going to see, like things like load shedding costs, as well as, the continued investment in cost savings initiatives, as well as, reduced losses from bash.com. So that should improve and improve margins. And then we saw that recently that there was less discount sales, which is supportive of GP margins. So I think it's lagged its peers. It's looking very attractive, and you've got that diverse portfolio, but you should see an improvement coming from the Africa business.
Thanks so much, Tbea. 4.9 million chickens a week.
A week.
The numbers do boggle the mind.
That's South Africa for you.
Yes, thank you. Just a note to our audience on YouTube that is watching us live. We are taking questions, so please keep those questions in the chat coming through. I see we've got 3 or 4 at the moment, and happy to take all of them once all of the speakers have told them their stock picks. Now, Nerina's got an interesting portfolio of picks, and Nerina, after telling us something interesting about yourself, won't you also just do a little 1-minute just overview on actively managed ETFs and actively managed certificates? These are new products in the market that have been really gaining traction in the last year or so. Welcome, Nerina.
Thank you, Sam. Thanks very much for having me, and welcome to everybody who's following us online. Something interesting about myself. I didn't really think that I was an interesting person, but what I find very interesting is I love to crochet. That's how I relax. That's how I do. Also, I think there's an aspect of being able to count. I sit and count a lot while I crochet. So that's really my my sort of downtime relaxing preference. But just in case people think that means I'm a hooker, because that crochet, you've got a hook, maybe I can add the other bit to say that I became an Oma for the first time not too long ago. So I'm now Gorgor. Yeah, so please treat me with the necessary respect from that perspective.
Congratulations, Nerina.
Thanks, Sam. Yes, you speak about actively managed certificates and actively managed ETFs. So I think for many people that do know about ETFs, very synonymous with the first ETF that was listed on the JSE back in the year 2000, so almost 24 years ago, being the Satrix 40 ETF. But we've seen such amazing evolution in this space. And today we talk about exchange-traded products, which incorporates exchange-traded funds, ETFs, exchange-traded notes or ETNs, and then the AMCs, actively managed certificates. And as the name suggests, it means that you're buying into a portfolio of investments that is actively managed by a portfolio manager, such as my distinguished peers that are with us today. Actively managed ETFs, we came full circle. So now we're back to this concept of an ETF. The underlying fund is a unit trust, a CIS fund, so huge, good governance structure and security in terms of how the underlying assets are being held, but it is an actively managed fund. And so AIM ETFs, as they're known, actively managed ETFs, have been available on the JSE for just about a year now. So not only a really interesting space, but also the area in which we are certainly seeing the biggest growth and the interest really rising. So I appreciate the opportunity today that on a show even called Stock Picks, that we can demonstrate that there are many other things that one can also pick on the JSE when you put together your investment portfolio.
Fantastic. So take it away then, some of your picks around AMT, ETFs and AMCs as well.
Yeah, thanks, Sam. Yeah, so you all certainly already alluded to it, and so did Gary also. You know, we find ourselves in a highly uncertain time at the moment. And so for many people, their go-to first investment ETF would have been a Satrix 40. But where we find ourselves in this period post-elections where there's the uncertainty around what the outcome would be, I would suggest to people that if you have a strong view in terms of how this is going to pan out, if your view is that we're going to come up with a political solution that will be very favorable to South Africa, you really want to be buying into what I would call SA incorporated shares, companies with very much a South African focus. And here I would buy the FNB mid-cap ETF. On the other side, if you're of the opinion that what's going to come out of this is not going to be so great for South Africa and probably result in a weakening of our currency, you still can invest on the JSE, but now you can buy something different, and that's the Satrix JSE Global Equity ETF. So these are still companies that are listed on the JSE, but they've got a much stronger global footprint, offshore exposure. Me, where I sit, I look at this and I say, I really don't know where these coalition talks are going to go. So I would rather focus on what I know for certain. And what do we know for certain at the moment? The level of interest rates. And so the first pick that I've got today is the PIP ETF, the Prescient Income Provider ETF. This is an actively managed ETF where you are, as an investor, buying into the Prescient Income Provider unit trust, a unit trust that's been around for 25 years and has got a very long track record of delivering to investors a very high level of certainty around interest income and virtually no capital drawdown. So one of their stated objectives is not to lose any capital over any rolling 3-month period. So I think that's a really powerful investment option to have alongside your stockbroking portfolio, where you can tap into this very high level of interest income. So the Prescient Income Provider ETF, and the code is PIP ETF. Quite like that idea of the pip. It's a little bit like the core of a fruit. So yes, that could certainly form the core of a portfolio at the moment when you are uncertain about the outcome that we'll have in South Africa post the elections. I then want to move on and actually follow on from, I think, some of what, again, my peers already suggested with us today. They all spoke about individual companies, evaluated them, analyzed them, spoke about the value proposition, their financial statements, why you want to buy into these individual companies. And when you buy into an AMC, an actively managed certificate, you would be buying exactly that type of value proposition of a portfolio of shares that actually is managed and overseen by a professional portfolio manager like my peers today. But because we are buying on the JSE, we are not only restricted here to South African companies when we look at what we can buy. And the first AMC that I'm going to be talking about taps exactly into one of the many global options that we have available via the AMC and the ETP industry. So the first one that I'm picking is the Standard Bank High Yielding Offshore Yielding Product, an AMC, and it's overseen and managed by High Street Asset Management. Now, as you can hear from the name, a offshore yielding product, the underlying investments in this portfolio, not only are you looking at mostly US companies, global companies, but when we use the term yield, they look at this from a very interesting perspective, because I think many people would think of yield as just being dividends. But they have a secondary strategy as part of their underlying strategy, and that is to invest in companies that also have a high share buyback program, because that is a different form of yield that you get from an investment. And I think what's really fascinating about the strategy of High Street is that when you look at companies that have both of these, the high dividend yields as well as the share buyback programs, they also deliver very good capital growth over the long term. But the dividend underpin actually gives you very strong base support during market downturns. And when you look at share buyback programs, that talks to a management team that really believes not just in the company, but they also believe in their ability in their market to continue generating enough cash flow to either pay out as dividends to investors or to buy back their shares. And when you look at these type of strategies over the longer term, they have significantly outperformed the likes of your, let's call it a broad-based S&P 500. Where we find ourselves globally, certainly we've seen the S&P 500 and with the so-called Magnificent Seven stocks really shooting the lights out. But you are really taking very concentrated risk in a very small number of stocks. And so if you are concerned about these very overextended valuation of many of the US companies, or not many of them, certainly those big ones, this type of strategy that High Street offers, I think is a great one to actually still give you that US company exposure, but focus on companies that specifically pay high dividends and do share buybacks. Just as a matter of interest, historically, these types of strategies typically have yielded on average 2.5% alpha, excess return over a broad market index, such as the S&P 500, for example. So that one's code, by the way, AMC 002 is that you're going to get there. And then I really want to pick up on something that Tbea spoke so well about when she spoke about famous brands, and that is about buying into brand value as a way to select good quality companies. And again, against this backdrop of being in an environment where our traditional big companies, the Magnificent Seven, have really sort of got very high valuations, we want to be focusing on good quality companies, companies that are very well run. And so when we look at the UBS Anbro World's Biggest Brands AMC, again, it's in the name. It is a strategy that focuses on selecting companies on the basis of their brand value. Now, this for me is also a fascinating strategy, because when you look at how brand value has evolved over years, you'll see that it really goes with the times. 50 years ago, your biggest brands were things like oil and gas companies or the motor companies and so on. Whereas, of course, nowadays we've got all the high-tech companies, the AI, the chip makers and so on, and biggest brands specifically captures that. So I think what I really like about this type of investor also, or this investment, is that it's something that it's very easy to familiarize yourself with, because it's brands that we know. Tbea spoke about some of the South African brands. Well, here we're going to be looking at brands such as, yes, your Apple, your Amazon, the likes of those, but you're also going to get your Coca-Cola, your MasterCard, your Visa, and from that perspective, buying into brands that you know really well. And the UBS Anbro World's Biggest Brands AMC will give that for you. Share code BRNDZ brands. They even have their own website, www.brndz.global. So do your homework, go and have a look, but certainly those would be ones that I would comfortably add to an investment portfolio at this time. Thank you.
Thanks so much, Nerina. Really interesting, very, very educational, and we are very excited to see where this actively managed part of the exchange traded products universe will go. So I do have some questions and comments from our audience. We have a thank you for unpacking the potash story. So Anderson says, I was wondering why Anglo American was holding on to the potash mine in their strategic review, because there is an opportunity here as the world population grows and food security becomes that much more important. We've got a question on Roynet, and Anderson says that Mustec has struggled with excess inventory on its renewables and is currently digesting that. Have we got similar issues with Roynet, or are they playing a different customer base, so that is not really a too much of a concern?
Okay, so yes, in the last results, they did indicate that there is an oversupply of the small batteries in the market, and therefore they were also impacted from a profitability point of view. I think if you look at Roynet, yes, they have the small battery market exposure to that, but they also have exposure to the much bigger energy storage products. So, I mean, they sort of products range from a 12-volt battery to around an 800V battery. So you can, and I mean, in the 800 or the bigger sort of energy storage products, there is still opportunity there as, big commercial corporates start installing their renewable installations, so that will continue to drive it. But yes, definitely you did see it in the last result.
Great, thank you. And a question from Pitso Mureme. So Pitso's got some interesting questions around what to look at in the financials of a company when assessing its investability. So anyone can take this who's feeling brave, but specifically he's asking things around sort of NAV. Should you be using NAV even though the market is forward looking, and also what kind of key ratios are important? Specifically, he's quite curious about sort of leverage and how our panelists think about leverage when assessing a stock pick. Any volunteers on this one? No volunteers. Do I need to stock pick?
Sorry, No. I'll answer as best I can. So I think it all depends on. I think from our point of view, if you're looking at the financial, the financial metrics on a company, it's important to understand the context in which those metrics are being reported as well. So you can't just look at a PE ratio, for example, and say, oh, well, that's the company. All of them tell a story, and it's actually easier to first start with kind of the fundamentals of what the company does, where does it operate, what are its products, understand the company first, then you can start looking at the fundamentals. The next thing that you want to look at is you need to compare it within the sector. A PE ratio for a mining company is going to be very different from a PE ratio for a chip maker overseas, for example, probably some of the two most extreme examples. But so I think that's the one thing. So not just compare the metric across different sectors, but then also compare the metrics to each other. So often one metric will influence another metric as well. So you need to kind of try and look at the whole picture and understand how everything is related together. Why is the company more indebted? And try and understand the story behind the numbers. That would be kind of my thing, rather than focusing on any one specific metric and drawing conclusions based on a single thing. It's just so easy to manipulate metrics through a million different ways that you use them kind of as it's the language that the company is talking to you about its profitability or its sales growth, but all of these things can change depending on why it's happening. For example, one of the things that we screen for example, when you're looking for momentum stocks, is you go and look at the 5-year compound annual growth rate and if that's been positive and what that value is. But that can easily be changed by a very acquisitive company. So again, you've got to just be very cognizant of why the metrics are being reported, and you really have to look at it in the context of the company overall. Would be my kind of advice at a very high level.
And I think that different industries will have very different income statements and balance sheets. So high leverage in one industry maybe low for another. And so I think that sort of understanding how a particular stock plays off against its competitors is interesting, which then actually takes me to another question that I'm just trying to find here, which was in the chicken space, kind of just saying views between Astral and Rainbow RCL, and we've got a listing coming up in that space. You want to give some thoughts there, Tbea?
Yes, I think in terms of market share, Astral has a bigger market share compared to RCL. But at the moment, you can't easily compare the two because RCL also have other businesses. But once they actually separate their poultry business, it's going to be a nice comparison for Astral. And I think if you are keen on poultry on poultry producers, then you've got two potential buys, and you can just kind of look at the differences between the two. But because of that, I still prefer Astral to RCL. I like the quality element of having the feed business with Astral. Even when times are tough, you've got this one element where it can really just keep on funding operations. And then with the cyclicality of the poultry business, once it comes back up and the margins improve on the poultry side, then you suddenly get these big earning upswings just now from the contribution from the poultry. So I think at the moment, in terms of which one I prefer Astral. It's got bigger market share, and it's just cleaner entry into the poultry market versus just Astral. But I'm looking out for that separate listing of the Rainbow business. It's going to be making it a bit more interesting in the market.
Yeah, definitely. It's always great to have more comparables in an industry. Just like we've got We Buy Cars coming in and giving another comparable against companies like Motus, etc. Nerina, Aubrey is being very kind and friendly, saying "Go Nerina" in his question. And asking whether it is advisable to buy an offshore ETF so that one can hedge the rand and political uncertainty.
Thank you, Aubrey. Thank you very kindly. I think it depends very much on two views. The easy one that a lot of people look at is their view on the currency. But if you are buying an offshore ETF or an offshore investment just for the purpose of expecting the rand to depreciate and therefore getting extra return in rand terms because of that, I think you're in dangerous territory. For the simple reason that we know how incredibly difficult it is to forecast currencies, and certainly it's not just the rand. There's also the denominators at the rand dollar or the rand pound or whatever the case might be. For me, the much more important motivation to buy a global ETF would be on the basis of two things. What growth can I get from that particular market? And typically we find that many of your global markets have got much better both global economic growth as well as market growth than South Africa and the JSE. But the other really important thing is diversification. We represent, as South Africa, represent way less than 1% of the investable universe globally. And so to restrict yourself to only look at local investments really mean that you're missing out on at least 99% of the rest of the investment opportunity set in the world. And so I would specifically look at global investments to do exactly that. Go and find those good growth opportunities in markets, in industries, in geographies that we don't already have exposure to in South Africa. I hope that helps, Aubrey.
Yeah, no, that's a great question. And then I've got a question that's from Daniel, which says, is franchising an NPO a good idea? I thought that was an interesting question. I suppose NPO here is non-profit organization. Do any of the panelists have any views on franchising in that space. Tbea, you were talking specifically around, famous brands and their franchising model and all of that. Have we seen NPOs as a franchisable business?
I've never, I mean, maybe someone else in the panel has heard of that, but I mean, the whole thing behind franchising is that you're actually selling your license so that someone can, operate under your brand, and it is to make money. So, and NPOs have got their rules around, profitability and what drives them. And it seems like what drives franchising is more commercial in nature than what you typically expect from an MPO. I don't know if anyone else has a different view.
Yeah, I also thought it was an interesting question, based exactly on that franchisors allow franchisees to license the brand, license the operations and the methodology, and then build on that. I did also think that it was interesting what you said about famous brands and the fact that their franchisees all have sort of a large percentage of them, I think you said 45%, have more than 10 years worth of experience in this space. Could that also be an indication that the rollout of stores could be faster? I don't know whether there's a flip side to that question.
No, they look, I mean, they're cautious on store rollouts because the macro is so poor, but they still are continuing to roll out stores. And then they're also converting stores from, different brands, depending on what they see in terms of consumer demands for specific brands. So store rollouts is still there. But remember, franchisees, it's almost like little businesses, and it's about the actual franchise, the person running the franchise, and what kind of experience they have with that franchise. People actually move, even maybe they might move from famous brands to like a KFC. That's also a reason why they move. That 45% might not just be from store rollout, but maybe they also move, and some have folded. I mean, remember that 10-year includes a COVID period where some people just, closed down because it was just such a tough period. But I think for me, what's appealing is that that's quite a high number of the guys that you have as your franchise partners with some serious experience, having gone through a tough macro environment. Yeah,
because I suppose for me as an investor in famous brands shares, I'm not just backing famous brand management, but I'm also backing that layer below of lots and lots of franchisees that run the stores day in, day out. Yeah.
Definitely. It's not just company-owned stores, it's the franchisees that's the bulk of it.
Yeah. Good. Well, that brings us to the end of our discussion. It's been an absolute joy from my side. Thank you so much, Gary Boyson from Rand Swiss. All the best with your next half marathon, and good to hear. And just to recap your stock picks: British American Tobacco, BHP Group, and First Rand. Natasha, thank you for joining us, Head of Research and an analyst at Mazi Asset Management. Maybe this will inspire you to pick up your Sudoku again. Your stock picks, Roynet, Bidcorp, and We Buy Cars. Tbea, thank you. Tbea is portfolio manager at Mianzo Asset Management and an avid F1 Grand Prix supporter. Good luck for your team this Sunday. Astral Foods, Foschini Group, and Famous Brands were her stock picks. And then Nerina, Fisser, Omar, Gogo. Thank you for just enlightening us about exchange traded funds, actively managed exchange traded funds, and actively managed certificates. and her stock picks included Prescient's Income Provider Actively Managed ETF, or the PIP ETF, Standard Bank's High Street Offshore Yielding AMC, as well as UBS MB AMRO's Capital World's Biggest Brands AMC. Thank you very much to our panelists. Thank you to our audience for your questions as well. It's been my absolute pleasure to stand in for Valdine Reddy. I am Sam Mokorosi, Head of Origination and Deals at the JSE, and we are looking forward to seeing you at the next one. Goodbye.